Hey there, investors. Welcome back to the channel. Today, we're tackling one of the most common questions I get asked. How do I actually pick stocks worth investing in? Whether you're just starting out or looking to refine your strategy, this video will walk you through a practical framework for evaluating stocks like a pro. Before we dive in, remember to hit that subscribe button and notification bell so you never miss our weekly investing tips. Now, let's get started. Before you select a single stock, you need to be clear about what you're trying to achieve. Let's break this down. First, consider your time horizon. Are you investing for short-term gains, 1 to 3 years, medium-term growth, 3 to 7 years, or long-term wealth building, 7+ years? Your time horizon dramatically affects which stocks make sense for your portfolio. If you're investing for retirement decades away, you can afford to take more risk and weather market volatility. If you need the money in 2 years for a house down payment, you'll want much more stable investments. Be honest with yourself about when you'll need to access these funds. Next, think about your risk tolerance. Be honest with yourself here. Can you stomach big market swings? Or do large drops keep you up at night? Remember, higher potential returns almost always come with higher risks. Some investors panic and sell at the first sign of trouble, locking in losses. Others remain calm during downturns, understanding that volatility is part of the journey. Know which type of investor you are and select stocks accordingly. If you're prone to anxiety during market drops, consider focusing on blue-chip companies with stable earnings rather than volatile growth stocks that might offer higher returns but come with major price swings. Finally, what's your investment style? Are you a value investor looking for underpriced gems? A growth investor seeking companies with major expansion potential? An income investor focusing on dividends? Or maybe you prefer a blend of approaches? Your personal style will guide which metrics matter most to you. Value investors might focus heavily on price-to-book ratios and free cash flow, while growth investors prioritize revenue expansion rates and addressable market size. Income investors will care deeply about dividend history, payout ratios, and yield. Take a moment to jot down your specific goals. This clarity will guide all your stock selections moving forward. Now that you've defined your goals, let's talk about evaluating a company's fundamentals. Think of this as the financial health check of any stock you're considering. Start with these key financial metrics. Revenue growth. Look for consistent growth over time, ideally outpacing inflation and industry averages. Erratic or declining revenue is often a red flag. Has the company grown sales by 10 to 15% annually over the past 5 years? That's typically a strong sign. Conversely, flat or declining revenues might indicate market saturation or competitive pressures. Profit margins. Companies with higher profit margins generally have stronger competitive advantages. Compare them to industry peers, not across sectors. Software companies often have gross margins of 70–90%, while grocers might operate on slim 2–3% margins. Both could be excellent investments, but you need the proper context to evaluate them. Also pay attention to margin trends. Are they expanding, stable, or contracting? Expanding margins often indicate improving operational efficiency or increasing pricing power. Debt levels. Check the debt-to-equity ratio. High debt isn't automatically bad, but make sure the company can comfortably service that debt through its operations. Look at the interest coverage ratio. How many times over can the company pay its interest obligations from operating income? A ratio below 2 suggests potential vulnerability to economic downturns or interest rate increases. Also consider debt maturity schedules. Is a large portion coming due soon, potentially forcing refinancing at higher rates? Companies with well-structured, manageable debt loads have more financial flexibility during challenging times. Cash flow. A company can show profits on paper, but still struggle with cash. Strong free cash flow indicates a business can fund growth, pay dividends, or weather downturns. Pay special attention to the relationship between reported earnings and cash flow. If a company consistently shows earnings but negative cash flow, that deserves deeper investigation. Where exactly is the money going? Capital-intensive businesses naturally require more ongoing investment, but the direction of cash flow trends matters tremendously. Ideally, you want to see operating cash flow consistently exceeding capital expenditures. Where do you find this information? Start with the company's annual reports, quarterly earnings releases, financial websites like Yahoo Finance or CNBC, and broker platforms often have these metrics readily available. Don't just rely on headline numbers. Dig into the management discussion and analysis sections to understand the story behind the numbers. What challenges does management identify? What strategic initiatives are they pursuing? This qualitative information often provides crucial context for interpreting the quantitative data. Pro tip: don't just look at a single year's numbers. Always examine trends over at least 3 to 5 years to get the full picture. Beyond the numbers, you need to understand what makes a company special. This is often called its moat, the competitive advantages that protect it from competitors. Ask yourself, does this company have unique technology or patents? Take pharmaceutical companies with protected drug formulations or tech firms with proprietary algorithms. These intellectual property assets can provide years or decades of competitive protection. Do they benefit from network effects, where each additional user adds value? Social media platforms, payment networks, and marketplaces often enjoy this advantage. The more people who use them, the more valuable they become to all users. Do they have strong brand recognition that commands premium pricing? Luxury goods makers like Ferrari or LVMH can charge substantially more for products that might not cost much more to produce than mass-market alternatives. Are there high barriers to entry in their industry? Consider industries requiring massive capital investment, specialized knowledge, or regulatory approvals. These factors naturally limit new competition. Do they enjoy economies of scale that smaller competitors can't match? Walmart's purchasing power, or Amazon's fulfillment network, allows these giants to operate more efficiently than smaller rivals. Take Apple, for example. Their ecosystem locks in customers, their brand commands premium pricing, and their scale gives them massive negotiating power with suppliers. Once consumers buy into the Apple ecosystem with multiple devices and services, switching costs become prohibitively high, both financially and in terms of convenience. Or consider Coca-Cola. Their distribution network and brand recognition represent competitive advantages built over decades. They can get their products into remote villages in developing countries more efficiently than newcomers. The wider and deeper the moat, the better protected the company is against competitive threats. Companies without clear advantages are often vulnerable to margin pressure and market share losses. Let's talk about industry and market trends that can make or break your investments. The most promising stock in a dying industry often underperforms an average company in a growing sector. Research industry growth projections, regulatory changes, and technological disruptions that could impact the sector. Consider the electric vehicle industry. Companies in this space benefit from multiple tailwinds, including government subsidies, improving technology, and growing consumer acceptance. Contrast that with coal mining, which faces regulatory pressure, competition from cheaper alternatives, and environmental concerns. Watch for disruptive innovations that could render existing business models obsolete. Kodak once dominated photography but failed to adapt to digital technology despite actually inventing the digital camera. Blockbuster missed the streaming revolution that Netflix pioneered. Entire retail categories have been upended by e-commerce. Try to envision how industries might evolve over the next 5-10 years, based on technological developments, changing consumer preferences, and emerging competitors. For example, renewable energy is experiencing tailwinds from policy support and falling costs, while many traditional retail businesses face headwinds from e-commerce competition. Also, consider broader economic factors. How does this company perform in different economic environments? Some businesses are cyclical, booming during economic expansion but struggling during recessions. Housing, travel, luxury goods, and heavy equipment manufacturing typically fall into this category. Others are defensive, maintaining relatively stable performance regardless of economic conditions. Utilities, consumer staples, healthcare, and discount retailers often show resilience during downturns. Understanding these patterns helps you build a balanced portfolio and set appropriate expectations for different market phases. You might want a mix of both cyclical and defensive stocks to smooth out your portfolio's performance over full economic cycles. Now let's discuss valuation, because even great companies can be terrible investments if you pay too much. Common valuation metrics include price to earnings, PE, ratio, comparing the stock price to its earnings per share. Generally, lower is cheaper, but average PE varies widely by industry and growth expectations. A mature utility might reasonably trade at 12-15 times earnings, while a high-growth tech company could justify a PE of 40 or higher if its growth trajectory is strong enough. Price to sales, PS, ratio, useful for growing companies not yet profitable. This metric helps compare companies in the same industry at similar growth stages. Software as a service companies, might sustainably trade at 10-20 times sales if they demonstrate strong retention rates and improving unit economics. Price to book, PB ratio, comparing market value to accounting book value. This metric is particularly relevant for financial institutions and asset-heavy businesses. Banks typically trade between 0.8 and 2 times book value depending on their return on equity and growth prospects. Dividend yield. Annual dividend payments as a percentage of share price. High yields can be attractive, but verify they're sustainable by examining the payout ratio. What percentage of earnings is being distributed? A company paying out 90% of earnings leaves little room for dividend growth or reinvestment. The key is context. Always compare these metrics to the company's historical averages, industry peers, and market averages. A stock trading at lower multiples than its historical range might be undervalued, or it might reflect deteriorating prospects. Do your homework to determine which. Consider the PEG ratio, price earnings to growth, which factors in expected growth rates. A PEG below 1.0 might indicate a stock is undervalued relative to its growth prospects. Also be aware of different valuation methods for different industries. Retailers might be valued on store sales growth and same-store comparisons, while software companies might be judged on annual recurring revenue and customer acquisition costs. Remember that valuation is both science and art. Numbers matter, but so does your judgment about future growth potential. Let me share some practical steps to put this all together. Start with a watch list of 15-20 companies you understand and find interesting. Focusing on industries you understand gives you an edge in evaluating business quality and competitive threats. Screen these companies using the criteria we've discussed: strong fundamentals, competitive advantages, favorable industry trends, and reasonable valuations. Dig deeper into the most promising candidates by reading their annual reports, earnings call transcripts, and analyst opinions. Pay special attention to management's capital allocation strategy. How do they prioritize reinvestment, acquisitions, debt reduction, and shareholder returns? Great businesses run by poor capital allocators rarely make great investments. Consider how each potential investment fits within your existing portfolio. Aim for diversification across sectors and risk levels. Avoid concentration risk where a single company failure could significantly damage your overall portfolio. Set price targets for buying and potential selling points based on your valuation analysis. I recommend documenting your investment thesis for each stock purchase. Write down exactly why you're buying and what could change your mind. Are you investing because of the company's expanding product line, entry into new markets, margin improvement initiatives, or industry tailwinds? Specify what metrics you'll track to confirm your thesis is playing out as expected. This documentation helps keep you objective when emotions run high during market volatility and provides a framework for making rational sell decisions when circumstances change. One last critical point. Even with thorough analysis, individual stocks carry significant company-specific risk. Consider these risk management strategies. Start with small positions and add gradually as your confidence increases. This approach, called dollar cost averaging, reduces the impact of poor entry timing and allows you to build conviction through experience with the company. Diversify across at least 15-20 stocks in different sectors. Studies show this level of diversification eliminates roughly 90% of company-specific risk while still allowing outperformance. Consider complementing individual stocks with index funds for broader market exposure. This hybrid approach lets you benefit from your best stock picks while maintaining a core position in the overall market. Regularly review your holdings against your original investment thesis. Has anything fundamentally changed? Are your assumptions still valid? Be willing to sell when your thesis breaks, even if the price hasn't moved against you yet. Remember that stock selection is an ongoing process, not a one-time decision. The market constantly evolves, and so should your analysis and portfolio. Thanks for watching. If you found this helpful, please hit that like button and share with fellow investors. Drop a comment with your favorite stock selection tip. I love learning from this community. Next week, we'll discuss how to determine position sizing within your portfolio, so make sure you're subscribed. Until then, happy investing!